Hello everybody, welcome to the channel, The Plunger God, and today I'm going to explain to you more towards option basic series on debit spreads. So what is debit spread? Debit spread is a strategy that involves buying, selling an option of a different type, like call or put, with the same expiration but different strike price. So the trader pays a net debit. Debit means they are paying money, right? To open the trade. Objective to profit from the directional move while limiting both profit and loss. So we can show you some example of type of debit spread. So one is called bull call spread. So from here, bull call means I buy for upside movement. It's a call direction, as in it's an option call, and spread means to buy and to sell. So basically, you buy a call at a lower strike and sell a call at a higher strike, so it becomes like a bandwidth. So what you want is the price move within these two strikes. The best will be the upper limit of the strike to get the most profit, or above the strike of the upper limit to get the full profit when the option expires. Use it when to expecting moderate upward movement. So bear put spread. So what do you mean by bear put spread? So bear put spread, from the name of it, is downside, right? Bear. So the bull means up, bear means down. Bear put spread will means to buy a strike at a higher strike, buy a put at a higher strike, and sell a put at a lower strike. So just inverse that how we create a bandwidth, like a yeah. So they have an upper limit and a lower limit. So if you buy and you want the price to go down to a limit of the price, so the lower strike will be the limit. Anything more, or sorry, anything less, you won't get more money because this is the limit. So I will explain to you later on why do you do that. Okay, so for this, use when expecting moderate downward movement. Okay, let's do some example. Example, bull call spread. Bull call spread, as the name of it, bull means upward movement, call is a directional, it's the things that you do, buy a call, right? And spread. So underlying XYZ. Okay, so this XYZ is just example. It's not square or any representative of any stock symbol. So you buy XYZ a call at $4, right? So if you sell an option, that means to say you collect premium. So you sell XYZ 105, the strike, this is a strike. This is a strike. You buy a call, strike price at $100, and you sell a call, strike at 105 for $2. So net debit will be $2 because $4 is the cost of purchasing and $2 is the premium that you're collecting. So you net off with $2. Maximum profit. So from here, so because I say MS mentioned just now is like a bandwidth, right? So 100 to 105, that's the maximum profit, $5. So minus away the $2 that you debit. So your max potential profit will be $300 if it expires at 500, right? So max loss 200 and you break even. So because you pay for $2 premium, right? Net $2 premium instead of 4. So your break even reduced to 102 instead of 104 upon expiration. Okay. So understanding the P&L curve. The P&L curve starts from 0 due to the debit. So as price rise, profit increase until the cap at the short strike. So which is the short strike will be the sell call, right? Beyond short strike, profit are capped. So if the price move higher than 105, you won't get additional profit because it's capped. One is the sell call will reduce the profit, the buy call will increase the profit. So you net you get 0. That's what it says upon expiration. Beyond the long strike, loss is capped at the debit. So instead of $4 loss, you are capped at $2 because you are collecting premium after selling at 105, $2. So right now you look into the bull call spread. So from here you can see that when the date to expiration is nearer, the curve is steeper, so are more sensitive to price movement. The higher dates is very least sensitive to price movement because there's the element of time. Time can change many things. So for here, this example, we will use strike 100 and 102 wide, $2 wide, okay? $2 wide. And IV is 30. So if the price move above 102, you won't get any additional profit for expiration. I mean, it's as for expiration. So this is a $2 profit, maximum $2 profit. If 3 days, at the 3 days, it moved to 107 around there, you get the full profit. But you see that for 15 days, even though you move at 105 or 107.5, you cannot get the near full profit because the gradient is very gentle. So the longer the time expiration, the gentle is not as sensitive as compared to the one nearer to the expiration. So these are the distinguished elements for different DTE, date to expiration options when you're doing a spread. Okay, so from here it will be the same. Bear put spread, $2 strike. You buy a put at 102, you sell a put at $100, $2 strike. So when the price move lower, cross over to 100, you see when it cross over 100 instead of this, it's roughly like $1.30 plus cents. But if the slope is gentle, you only get less than 125. So if your spread is much bigger, much wider, they can see a very big differences in terms of the profit and loss by purchasing near DTE and far away from DTE. So time decay, data and option grids. Negative overall, but offset partially by shorting legs. That means to say you are paying more Theta if you just buy a call, straight call. But it offset by a little bit of Theta by selling the call. So Theta means daily you pay for a premium. If you buy a call, you pay for premium every single day. How? They will just slowly, your value of your options would slowly become lower. That's how you are paying for the premium. So likewise, if you sell a call, your premium for the call options will reduce. That means you are collecting that money. So both of them offset and your data become lower, but still negative. Okay, so delta, positive for bull call, negative for bear put. So when you want to do the directional trade, you want data positive for upward movement and data negative for downward movement. So this is very clear cut. If I want negative data, that means I want the price to go down. If I want positive data, that means I believe that the stock price will go higher, right? So Vega positive benefit from rising volatility. So higher it is more sensitive to volatility. That's all. So gamma, higher near the money, sensitive increase near the strike. Okay. So implied volatility, what is impact? Low IV, cheaper entry, ideal setup. So rising IV, increase in value of the spread. So not wise to do a debit when the IV is rising. High IV at entry, expensive setup, hard to profit. So unless strong movement expected. That means to say you want to stretch very far because you foresee that the volatility is high, you move further. So you want the spread to be slightly wider to get the maximum gain. If you do the very narrow one, most likely you are paying quite a lot of premium to it, and your R to R ratio, which is the win to reward ratio, isn't there. Like for example, you see this, you pay $2 and your maximum profit is $3. So your R to R is roughly 1.5. But usually you don't collect the full $3 because unless you want to hold through expiration, so if not you won't get the maximum of $3. Okay, so advantage and disadvantage of it, limited and defined risk. Advantage of it, lower cost versus buying a naked option, which is naked option means straight call or straight put. As an example, just now I showed, if you buy a straight call or straight put, it's $4. So you net off with collecting premium, so reduce the cost to $2. Okay, so easy to manage, and you rely on data decay. So you don't need to do anything. You know, okay, whether the price move up or down. That's all. After you enter the trade, you know where's your stop loss. If you have, depends on your strategy. Okay, then you see how it works. You don't need to adjust anything. The only thing you adjust is to exit the position. So the disadvantage is limited profit potential or require accurate direction forecast. So if you choose a wider spread, that means to say you have to be more right than wrong to choose how far you're gonna move within this period of date of expiration. If you're wrong, it'll cost you the whole contract size or contract amount. So underperform if volatility drop or price stagnant. So suddenly, if the volatility drop, then you will lose more of your premium contract. Because as I mentioned, you want to buy when the IV is low. But if the volatility drop further, that means to say your contract value drops even lower. So you start to lose money not because of the direction, you lost in terms of the volatility price. So if price stagnant, that's not what you want, because when you do a bull call or you debit, you want to look for a directional trade, not something that sideways or little movement. Okay, so when to use debit spread? Ideal condition. Expect moderate directional move, low IV environment, define risk profile preferred. So if you know how much you're gonna lose and you cannot afford to lose that whole contract, like if you buy a straight call, if it costs you $4, which is equivalent to $400, and you think that the risk is too high, so you do a debit call, instead bull call spread for $2 instead of $4. So if things move, you only lose $200. Or if things doesn't go into your favor, you only lose 200 instead of 400. So upwards movement cap. So avoid when the IV is high, expensive entry, expecting sideways or market or small movement. So these are the things that you do not want to do debit. So you have to understand where the market is heading, then apply the correct strategy. Not saying everything I want to do debit spread or uh, when I see a setup. So you have to understand why would you want to do that. So more towards like you have to slightly be in tune to the market to understand, is the price movement gonna move violently or not? This is something that you have the right direction and time. So risk management and exit strategy. So ideally you can this is some idea that you can ponder upon. Stop loss of debit paid 50%, for example. You have to do your own due diligence or do your own data collection. It's just an example that people does. You can do 100%, totally up to you, if you have a strategy to approach this. So options wise, it's like strategies. You have to know when and what to apply at the correct time. So you don't want to apply to buy a debit spread when the IV is really high because you're going to pay more. So this is not the strategy. You can do different strategy. Yeah. So profit target 70% to 90% maximum gain. So you cannot get the full one. So just like I mentioned, your R to R has to be realigned according to that, because you only can get 100% upon expiration. So 70% to 90%, okay, I think is enough. Let's move on to the next trade. So this 70% to 90% profit, right, have to make sense in terms of risk to reward, unless your accuracy is very high. Then if not, the best is to see how much you want to, in the long term, whether is this strategy making you money or losing you money in the long term. That's what you have to understand and also record down accordingly. So avoid holding through earnings. So IV crash after that, right? So IV is high before earnings. Then after earnings, you got crash. So roll or close early as data accelerate near expiration. So if this data is not working in your favor and you do not have the maximum profit, then you have to buy more time to see it through. Or you can close the trade early as a loss. Small loss, yeah. So you don't lose everything. So in summary and key takeaways, debit spread are excellent for defined risk directional play, profit from moderate movement, and low IV setup. Understanding the grids and monitor the data decay, great strategy for trader to seek for consistency and control exposure. So control exposure more towards like a capital at risk, lesser amount required. Summary and key takeaway, debit spread, pay premium for directional exposure. Define risk to reward. Choose based on IV trend, volatility, and expectation. Volatility expectation. Great for traders seeking for control exposure with limited risk. Okay, so that's all for a very quick summary for debit spread. And any question, just leave in the comment section. Okay, so I'll show you some of the real example of how you construct a debit spread. So for example, bull call spread, this is the left side is call, this is call, and this is put. So just now I mentioned on you select this, like for example, I select 634, then I want to sell a spread at 635. You see this costs me 66 cents, right? So if I sell at 635, I collect 19 cents. So roughly you can tabulate that roughly, right? 66 minus 19. The cost of it is about 47 cents for this contract. 47 cents. Let me see, is it 47 cents? Yeah, roughly there, 47 cents. Yeah, 45 to 47 cents. So instead of paying 66 for upward movement, I only pay 0.4, and the DT is 0. That means to say expired today. So this DT is 0. No time for you to play around. Either you're correct or wrong. So this is a very sensitive thing. So if you're correct, then you pay 66 45 cents or 47 cents for $1, $2, $3 movement. $3 minus 67, which is $3 minus 6 0.47, which is $2.53. So you can do your R to R calculation from there. So when the market is open itself, it'll give you a fresh list of option pricing. This is just an example for you to see how you want to construct. So if you are doing IBKR, you can straight on the strategy builder for combo. Like you can do a combo, you do this, you buy this. So if I do the bear put spread, buy this, and I sell a $3 white spread. So I'll pay for about $1 and okay, so I put it simple. So this is the bid and ask. I'll do it in the middle, $1.80. So $3 you pay for $1.80. That means you will get about $1.20 move. What, 1, 2, 3, yeah, $3 move. So you get about $3 movement of price. So you pay 180 to get 120. So seems like not a very good auto R. Okay. So that's all for today. So like and subscribe to our channel if you find it very helpful. And I will see you again for the next session on